In the year 2000, $100 could buy you about 20 blockbuster movie rentals. But if you took that exact same $100 and instead of spending it on weekend entertainment, you quietly tucked it away into one specific, incredibly boring account every single month until today, you wouldn't just be sitting on a nice rainy day fund, you would be looking at an entirely different life. Most people think they missed the boat on building real wealth, or that it takes a six-figure salary to start, but the math proves something far more terrifying. Here is exactly what happened to that money and why the exact moment you felt like a financial failure was actually the moment you became rich. Today, $100 is basically a weekend bar tab, or 2 decent Uber Eats orders after delivery fees. It leaves your bank account so fast you don't even process the loss. But let's rewind the clock to January 1st, 2000. You make a single, permanent decision. On the first of every month, $100 is automatically deducted from your checking account and dropped into an S&P 500 index fund. You never look at it. You never touch it. There's just one massive problem. You have accidentally chosen one of the absolute worst times in modern human history to start investing. Because almost immediately, the dot-com bubble bursts. By the end of 2002, the stock market has crashed. For 3 straight years, you have sacrificed your $100 a month. You've put in $3,600 of your hard-earned cash, and your account is sitting at $2,500. You've lost over $1,000. Your friends who kept their money in a regular savings account are laughing at you. The news is telling you the market is dead. The math is telling you to quit. But you don't. You ignore the pain, and the $100 keeps transferring. By 2007, things finally recover. Your account creeps up to around $12,000. You're feeling good. You're finally ahead. And then 2008 happens. The housing market collapses. Banks go bankrupt. The Great Recession wipes out millions of jobs. You log into your account in early 2009. You have now been investing $100 a month for over 9 years. You've contributed almost $11,000. Your balance is barely $7,000. After nearly a decade of discipline, you have lost a third of your money. This is the exact moment 90% of people panic, sell everything at a massive loss, and swear off investing for the rest of their lives. Except you don't. You leave it alone. The $100 transfers again the next month, and the next. And this is where the financial laws of gravity completely flip. Because you didn't just hold your money during the 2008 crash, you kept buying. Every single month, your $100 was buying pieces of the greatest companies on earth at a 50% discount. You were shopping during the biggest clearance sale of the century. The 2010s begin. The market starts to slowly climb. By 2014, your account crosses $30,000. By 2017, the compounding effect begins to snowball so fast it breaks your brain. Your money is now making more money by itself in a single year than your actual $100 monthly contributions. Your money has hired its own employees, and they are working for you 24 hours a day, 7 days a week, with no sick days. Then comes 2020, a global pandemic. The market nosedives again. But you've seen this movie before. You let the $100 transfer. The market violently rebounds, which brings us to today, 2026. You have been giving up $100 a month for 26 years. You skipped the extra streaming services. You skipped a few dinners out. Over 312 months, you have taken exactly $31,200 out of your own pocket. But your account balance doesn't say $31,200. Your account balance sits at over $158,000. Read that again, over $158,000. More than $126,000 of that is pure profit, money created out of thin air. You didn't work a single hour for it. You didn't ask your boss for a raise. You just bought time. Remember when we said that the year 2000 was the worst possible time to start? That was a lie. Because if you had waited for the perfect time, if you had waited for the news to sound positive or for the economy to feel perfectly safe, you would have missed the exact dips and crashes that allowed your $100 to buy cheap and explode in value later. The worst time to start is tomorrow. Your brain is going to tell you that you don't have $100 to spare. But look at your phone. Look at your subscriptions. Look at where your money bled out over the last 30 days. The true cost of a $100 pair of shoes today isn't $100. The true cost is the $1,500 that money would have become over the next 2 decades. Every dollar you spend today is stealing from your future wealthy self. The best time to start was the year 2000. The second best time is right now. If you're ready to stop making the $100 mistake, watch this video right here, where I show you exactly how to set up the $0 hack to automate your wealth before you can even touch your paycheck. Don't let another decade pass you by.